Welcome to another deep dive. Today we're cutting through the noise to understand one of the biggest players in global finance, Morgan Stanley.
That's right.
We've got their 2024 annual report right here, an absolute, gold mine of insights. And our mission is to distill what you really need to know.
Yeah.
Think of this as your personal shortcut, to being deeply informed about how this financial giant operates, innovates, and plans for the future.
It is a fascinating document, definitely packed with critical details. We'll unpack their core business segments, dissect the key financial figures that tell their performance story, and then look at how they're strategically planning to create value for shareholders while, navigating a truly dynamic global landscape.
Right.
It's about seeing not just the raw numbers, but the underlying strategy and, the evolving challenges shaping their path.
So if you've ever wondered what truly drives a firm like Morgan Stanley, from its huge institutional dealings to how it manages individual wealth, this deep dive is for you. All right, I'm really keen to dig into this report today. Where do we even start to grasp the scale of their operations?
Well, let's start with their foundation. Morgan Stanley organizes its vast global operations into three distinct pillars, each playing a crucial role in their overall strategy.
Okay.
Institutional securities, wealth management, and investment management.
Okay, so let's break those down. What's the big picture for each?
Absolutely. First up, institutional securities. This is where they serve the big players, corporations, governments, other major financial institutions.
Right, the heavy hitters.
Exactly. It's their powerhouse for trading, investment banking, market-making activities, covering everything from complex credit products to commodities and equity financing. What really stands out from the report, actually, is that their equity net revenues in this segment shot up by 22% in 2024.
Wow, 22%. That's significant.
It really is a significant jump, signaling strong performance in execution services and financing, particularly noticeable in fast-growing markets like Asia and the Americas.
So that's not just a number. It points to something specific they're doing well.
Yeah, it points to them capitalizing on specific market conditions, maybe a resurgence in M&A or IPO activity, showcasing their strong client relationships and market-making prowess.
Right.
Of course, this segment is also highly exposed to market volatility and credit risk, just given its nature.
That 22% jump in equity net revenues is really eye-catching, though. Does that suggest, a particular strength in their trading desks, or is it more about the broader market conditions right now?
It's likely a combination, I think. The report kind of hints at both robust client engagement on their trading platforms and a more favorable environment for deal-making and capital raising, especially in those regions you mentioned.
Okay.
Then we move to wealth management. This segment caters more to individual investors and small to medium-sized businesses, offering a really comprehensive suite of services, everything from financial advisor-led brokerage and self-directed platforms to lending products like securities-based loans and residential real estate loans.
And this is a big growth area for them, right?
Oh, yeah, a real growth engine. Net revenues here grew a healthy 8% in 2024 to $28.4 billion.
Okay.
That growth was largely due to higher asset management revenues and transactional revenues.
So wealth management is clearly thriving. But I noticed something interesting in the report about net interest income within that segment. What was that about?
Yeah, that's a crucial detail. So while overall wealth management revenues grew, their net interest income actually decreased by 10% in 2024.
Down 10%. Why was that?
Primarily from lower average sweep deposits, the funds clients hold that earn interest.
Right, okay.
This was somewhat offset by higher yields on their investment portfolio and lending growth. They do note their balance sheet is asset sensitive.
Asset sensitive, meaning?
Meaning net interest income generally increases when interest rates are higher. So this is a key point for Morgan Stanley. It suggests they are, pretty well positioned to benefit if rates continue to climb. But it also highlights a potential vulnerability if rates were to fall sharply, impacting their profitability from lending and deposits. It's a delicate balance.
That makes a lot of sense. So they're managing that interest rate exposure carefully. And finally, the third pillar, investment management.
Right. Investment management. This provides a broad range of investment strategies and products to institutional and intermediary clients. Covers equity, fixed income, alternative investments. The works.
And how did they do there?
Their net revenues here saw a solid 9% increase in 2024.
Okay.
Driven by a combination of asset management and performance-based fees. So showing strength in their ability to attract and manage client assets effectively.
So it's clear Morgan Stanley has these three strong, distinct segments driving their business. But, you know, a giant like this doesn't operate in a vacuum.
Definitely not.
Beyond their internal strengths, what external forces, the broader market trends and challenges, are shaping their journey across all these segments.
That brings up a critical point. The report highlights intense competition across the board, not just from the usual suspects, the traditional banks, but also from new fintech firms constantly innovating, especially in the digital space.
Always disruption there.
Always. And they also face an increasingly complex and, frankly, stringent regulatory environment. We're talking about more demanding capital and liquidity requirements like Basel III.
The global standards.
Exactly. And the Volcker Rule, which limits proprietary trading. Both of these can significantly increase operational costs and potentially put them at a competitive disadvantage.
Yeah, that regulation piece is huge.
Yeah.
Beyond the market and regulation, what about the less obvious risks? The things that might, keep executives up at night?
This is where it gets really interesting, I think. Operational risks are a constant concern, stemming from inadequate or failed internal processes, human factors, or external events like cyber attacks.
Cyber must be massive for them.
Oh, huge. The report explicitly mentions the growing sophistication of cyber threats, amplified by new tech, even AI being used by malicious actors,
Wow.
posing significant risks of data misuse, business disruption, reputational damage. It's a major focus.
And other risks.
There's also a clear focus on credit risk, especially in their institutional securities and wealth management lending activities. They rely on complex models,
Right.
subjective judgments for valuations and reserves. And, tellingly, they acknowledge the increasing concern over climate change.
Climate change, how does that factor in?
Well, they note that both physical risks, like extreme weather, and transition risks, like shifts to a low-carbon economy, could impact their operations, their businesses, clients, even their reputation.
Wow, that's a lot to navigate. It truly paints a picture of how complex these operations are. How are they actually addressing these myriad internal and external pressures?
Well, they emphasize a robust enterprise risk management framework, or ERM, to identify, measure, and mitigate these risks across the entire firm. Their core values: put clients first, do the right thing, lead with exceptional ideas, commit to diversity and inclusion, and give back. They position these as central to their workplace culture, guiding decisions. They also have robust employee compensation programs, designed not just to attract and retain top talent, but crucially to align incentives with shareholder interests and, importantly, mitigate excessive risk-taking.
So tying pay to responsible behavior.
Exactly, including enhanced benefits and expanded mental health and well-being training, too. It's about building resilience from the inside out, really.
Now that we understand what Morgan Stanley does and the landscape they operate in, let's look at the financial scorecard. What do the consolidated financials tell us about their overall health and performance in 2024? Did that strategic focus on wealth management pay off?
Okay, let's unpack this. Their total net revenues hit an impressive $61.7 billion in 2024.
$61.7 billion. How does that compare?
That's a notable increase from $54.1 billion in 2023. And this growth wasn't just isolated to one place. Net revenues in the Americas increased by 13%, EMEA by 19%, and Asia by 19% in 2024.
Okay, so broad-based growth. That's a good sign.
Very strong indicator of diversified strength, yeah.
What about the cost side of the equation? Were they able to manage their expenses effectively amidst that revenue growth?
Well, total non-interest expenses rose to $43.9 billion. A significant driver here was compensation and benefits.
Paying their people.
Exactly. That increased 7% to $26.1 billion, primarily due to higher formulaic payouts to their successful wealth management reps.
Right, linked to performance.
And increased discretionary incentive compensation directly linked to those higher revenues we just talked about. So in a way, higher revenue led to higher comp, which isn't necessarily bad.
Makes sense.
Interestingly, though, non-compensation expenses actually decreased slightly.
Oh, really?
Yeah, thanks to lower professional services and legal expenses. Partially offset by increased tech spend, but it does show some efficiency gains there.
So with revenues up and kind of mixed signals on expenses, how did all that translate to the bottom line?
The bottom line: net income applicable to Morgan Stanley bounced back significantly, reaching $6.6 billion in 2024.
$6.6 billion. And the bounce back.
A remarkable 93% increase from 2023.
93%. Wow.
Yeah. That 93% jump isn't just good news. It signals a robust recovery. Maybe successful cost management or strategic pivots from prior years paying off.
It suggests a strong foundation then.
Exactly, indicating a strong foundation for future profitability, even in uncertain times. Their consolidated pre-tax margin for the firm was 26%.
26% pre-tax. Pretty healthy.
It is, yeah, a healthy profitability metric.
Let's talk about the balance sheet, the foundation of a financial firm. What does it tell us about their financial strength?
Okay, balance sheet. At the end of 2024, their total assets stood at $1.215 trillion.
1.2 trillion. Huge.
Think of that as the total financial muscle they command. Yeah, from loans to investments. Deposits were a substantial $376 billion, and borrowings at $288 billion.
And lending.
Interestingly, their total loans increased by approximately $47 billion in 2024.
Okay.
This growth was primarily due to increases in corporate lending and secured lending facilities within institutional securities and across various portfolios and wealth management.
So putting their money to work.
That's them putting their money to work, exactly. Funding more businesses and individuals, a sign of both confidence and growth in their lending operations.
And what does that tell us about their ability to manage liquidity and capital, especially in a volatile market?
This is key. What really catches the eye here is their incredibly strong capital and liquidity positions.
Also?
They reported a liquidity coverage ratio, or LCR, of 130%.
Okay, LCR 130.
And a net stable funding ratio, NSFR, of 113% at the end of 2024.
Both well above the minimums, right?
Yeah, comfortably above the 100% regulatory minimum, yes. These are key indicators of their short-term and long-term funding stability, basically. How easily they can meet obligations, even in tough times.
Can they stress test this?
They do. Their internal liquidity stress tests even assume no government support and limited access to unsecured debt markets in stress scenarios.
Wow, that's conservative.
It speaks volumes about their conservative approach, yeah.
Managing potential funding challenges very carefully, and their capital ratios. Common Equity Tier 1, or CET1 capital ratio was 15.9%, and Tier 1 capital ratio was 18.0%.
Again, well above requirements.
Well above, indicating robust financial strength and, frankly, ample buffer against unforeseen events.
A strong financial position is definitely key, but how does Morgan Stanley translate that into tangible value for its shareholders? This is where the rubber meets the road for investors, isn't it?
That's exactly right. They actively manage their capital base with an eye towards business opportunities, managing risk, achieving attractive returns, all while strictly adhering to regulations. And for shareholders?
For shareholders, this manifests in two key areas: dividends and share repurchases.
Okay, buybacks first.
Yep. In 2024, they repurchased $3.25 billion of common stock,
$3.25 billion.
acquiring 33 million shares at an average price around $99. And in June 2024, their board reauthorized a significant multi-year share repurchase program of up to $20 billion.
$20 billion authorized. That signals strong commitment.
Absolutely, a strong commitment to returning capital.
And what about dividends? That direct return to shareholders.
They increased their quarterly common stock dividend, too, up to 0.925 cents per share from $B.85 starting July 2024.
Nice bump for dividend investors.
Yeah. And what enables them to do this, hike dividends, buy back shares, it's directly linked to how they perform on those tough stress tests from the Fed.
Ah, the connection again.
And their compliance with capital requirements. So their strong regulatory capital ratios we just discussed, they provide that financial muscle and capacity to take these actions.
So we've seen strong performance in 2024, clear strategies for shareholder value. But looking ahead, what does all this mean for Morgan Stanley moving forward, especially in this truly dynamic global economy?
This naturally leads us to consider the path ahead, right?
Yeah.
While the economic environment did improve in 2024, the report is very clear. Elevated inflation, ongoing geopolitical risks, uncertainties around future interest rate actions, these continue to present significant risks.
No easy road ahead then.
Not necessarily. Their robust enterprise risk management framework and those strong capital and liquidity positions are absolutely crucial as they navigate these uncertainties.
Makes sense.
They also continue to adapt to evolving regulatory requirements, including resolution planning.
Resolution planning. Making sure they can handle failure without taking down the system.
Essentially, yes. Making sure they have a plan to absorb potential losses and wind down without disrupting the financial system should the worst happen.
And their targets.
Their stated return on tangible common equity goal, ROTCE, is 20% in a normal market environment.
20% ROTCE. Ambitious.
It signifies their continued focus on efficiency and profitability, yes. But It's important to remember that such goals are forward-looking and very much subject to those market and economic conditions we just discussed.
What a deep dive. We've unpacked Morgan Stanley's strategic segments, drilled into their financial highlights, and seen how they're actively managing capital to return value to shareholders, all while keeping a watchful eye on a complex and evolving risk landscape.
Yeah, it's clear that while they've demonstrated really strong performance and sound financial health in 2024, their success moving forward will definitely hinge on their ability to keep adapting.
Yeah.
Adapting to a constantly shifting global economic and regulatory environment, and to proactively manage both traditional and emerging risks, like those from cyber threats and climate change we touched on.
Right. So for you, our listener, here's a final thought to maybe mull over.
Right.
Considering the rapid pace of technological change and increasing geopolitical instability, how might a global financial institution like Morgan Stanley further integrate its core values, like put clients first and do the right thing, into its risk management strategies?
Yeah, how do they do that to maintain trust and relevance?
Exactly, especially as it continues to expand its reach and innovate in this really interconnected world. Something to think about.
Definitely.
Thank you for joining us for this deep dive.